You've probably heard the word pullback or retracement or correction quite frequently if you are interested in trading the financial markets. What is a pullback? A pullback in a market is a pretty easy concept to define and understand. It's a period when price retraces back on a recent move, either up or down. It's basically a reversal of a recent price move. Why are pullbacks so important? For a number of reasons. They are opportunities to enter the market at a better price, and they allow for optimal stop-loss placement and improved risk-reward and more. A pullback entry is more conservative than a market entry, for example, and is considered a safer entry type. Ultimately, the goal of a trader is to obtain the best entry price and manage risk as good as possible, while also increasing returns. And the pullback entry is a tool that allows you to do all these three things. So here is why pullback trading is very important. First, when identified correctly, will offer you higher probability entries. The very nature of a pullback means that price is likely to continue moving in the direction of the initial move when the retrace ends. Hence, if you see a strong price action signal at the level following a retracement, it's a high probability entry because all signs are pointing to the price bouncing from that point. Now, it doesn't always happen, but waiting for a retrace to a level with a signal is the highest probability way you can trade. Markets rotate back to the mean or the average price over and over. This is clear by looking at any price chart. So when you see this retrace happen, start looking for an entry point because there's a much higher probability entry point than simply entering at the market like most traders do. Second, it offers better risk rewards. Pullback entries theoretically allow you to place a smaller stop loss on a trade because you're entering closer to a key level. So if you choose to do so, you can place a stop much closer. For example, a 100 pips stop loss and 200 pips target can easily become a 50 pip stop loss and 250 pip target on a retrace entry. Of course, you don't need to place a smaller stop loss. This is optional, but the option is there on a pullback entry if you want it. At the same time, a pullback entry allows more flexibility with your stop loss placement. Of course, there are some negative aspects in what concerns waiting for a pullback. You will have less trades in general. A lot of the time, markets simply don't retrace enough to trigger the more conservative entry that comes with a pullback. Instead, they may just keep going with minimal retracements. This means you will have less chances to trade as compared to someone who isn't primarily waiting for pullbacks. Also, you will have more missed trades. Some potential good trades will get away when waiting for the retracement. This can test your nerves and will annoy you sometimes, but missing out on trades, it's not the worst thing in the world, and it's better to miss out on some trades than to overtrade. Now that you know the pros and the cons of a pullback approach, let's take a look at some different pullback entry types. The first one, pullback entry without any price action signals. In this chart, you can see the price pulled back to the key horizontal level shown in this chart. There was no obvious price action signal here, but we can see the price quickly sold off from that level after just barely pushing above it. This provided a very high potential risk-reward scenario if you decided to enter on a blind entry at that level with a tight stop loss. That's the most aggressive entry. As soon as the price hits an important level, you buy or sell at the market immediately. You don't wait to confirm your buy or your sell signal with reversal candlesticks or signals from indicators, for example. You just immediately buy or sell at the market. If the price hits the key level and bounces back, you make money. If not, you lose. It's that simple. The second entry, pullback to a key level with price action confirmation. A more conservative trading strategy is to wait for price to retrace back up or down to an existing key level, then watch for an obvious price action signal to form there. This is one of the highest probability ways to trade. A way to look for confirmation when using pullbacks would be to look at Japanese candlestick formations, because these tend to be reliable signals of a reversal in price action. In particular, on this chart, an engulfing pattern forming right on this key level could be a sign that the price is ready to turn. For additional confirmation, you can apply technical indicators such as stochastics or MACDs to determine if it's a good time to enter a trade or not. Take note though that using too many technical indicators doesn't necessarily improve their reliability. In fact, too much indicators might lead to an extremely cautious trading strategy that misses out on several valid trade signals. The third entry, pullback to a moving average. Markets have a tendency to retrace to the mean or the average price, which you can see by putting a moving average on your charts. Moving averages are useful for identifying and confirming support and resistance levels. Most support and resistance levels, like market highs and lows, pivot points, are static levels. Moving averages offer dynamic zones of support and resistance because they are changing depending on recent price action. On this daily chart, we added a 20 exponential moving average, a short-term moving average to identify the trend. A simple moving average could be considered as a dynamic area of support or resistance, but also the area between two moving averages could also be considered as a dynamic area of support or resistance. When price retraces back to this area, you should watch closely for price action signals forming there to get a high probability entry and get in on a trending market. Using candlestick patterns with a moving average helps to clarify the trend. It also helps you to evaluate the pullback pattern better. Hence, combining candlestick patterns with a moving average is a simple yet effective approach for trading pullbacks. This is EUR/JPY on the daily chart. We have a pin bar right on the 20 period exponential moving average, which is a high probability pullback trade. So start paying attention to price action patterns around moving averages. The fourth entry, pullbacks to the 50% Fibonacci area. Price has a tendency to retrace approximately 50% of any major move. This is a very well documented phenomenon, and if you look at any chart, you can see it happen a lot. Hence, you can watch for pullbacks to these 50% areas, as they will very often be high probability levels for price to move beyond, and as a result, price moves back in the direction of the initial move from that 50% level. It doesn't happen every time, of course, but it happens often enough to make it a critical tool in your pullback trading toolbox. I prefer to pay an extra attention to the 50% Fibonacci area of a move and look for trade entries. This chart shows the 4-hour activity on the pound dollar. This is the first strong upswing after a downward move. We drew the 50% retracement level of the bullish movement. This sharp retracement found support at the retracement zone. The candlesticks that followed confirmed the bullish pressure. As you can see, we had two pullbacks, unable to break below the 50% retracement area. You can use trendline breakouts for pullback entry, or search for obvious candlestick patterns, or even entries based on oscillators or indicators. Trading pullbacks in a trending market is one of the most efficient trading strategies out there. The beauty of a pullback trading system is that you enter the market or place your first trade only after confirming which way the market is going. Doing this is going to help you to eliminate entering the market with a false signal. Since most markets remain within a range bound or consolidation phase most of the time, and the market trends only about 20 to 30% of the time, finding an established trend to trade pullbacks can be a challenging task. As a trader, when you are trying to apply a pullback strategy, you need to act like a sniper. You need to wait and have discipline and patience before pulling the trigger. Also, very important, you need to make sure that you have identified the correct turning point where the pullback move is likely to end. It's your job to find a way to generate a high probability pullback signal where the price is likely to resume the prevailing trend. If you can successfully do this, you can buy low during an uptrend and sell high during a downtrend, and this can only bring profits in the long run. If you learned something new and found value, don't forget to subscribe, click the bell icon so you will be notified each time we upload, and leave us a like to show your support. Until next time.